My name is Benton Blake with Rise Wealth Management and Planning. So I have Skylar Martin with us from Vancouver, Washington. Thanks for joining us again. This is rendition of this podcast or YouTube channel where I bring Skylar on and we talk about current problems and solutions we're running into when working with clients.
No, Ben, it's great to be here, and I'm excited to jump into today's topic because this is one that you brought up when we were talking not too long ago, and it made me realize, wow, I could learn on this, and so I'm excited to hear what you have to say.
Yeah, and this topic is so complex in that, there's parts too where I'm still going to the books to look at it exactly. I had a really good conversation with a financial advisor the other day about this topic, which is QBI or qualified business income, particularly the deduction you get on that income. And I learned some stuff that I didn't know in talking to him. So I thought it would be helpful to have an episode where we go over QBI and kind of break it down.
Yeah, no, that's great. And that's why I love having these conversations, is because we have so much to learn still, and that's the beauty of this industry. So yeah, let's talk about it. Most people have heard about the 20% business income deduction, the QBI deduction, like you mentioned, but not a lot of people understand how it actually works. So can you kind of break that down for us?
Yeah, first and foremost, it's a 20% deduction on business income that comes to you not as a wage. So if you're a sole proprietor, we're talking net income. The bottom line, S-Corp, we're talking about what comes to you, not your wage. But it's a way to help reduce that taxable amount just by reducing what you owe on that business income.
Great. So it's not a credit, correct?
Correct. Yeah, good point. Credits obviously offset one-to-one. Deductions help reduce your taxable income. But what's nice is a hefty percentage, 20% deduction. If you have $100,000 in business income, you're only paying taxes on 80 of it.
Yeah, that's awesome. So you don't have to be an S-Corp then to get that QBI deduction. Is that right?
Correct. Entity is not necessarily key. When you get to phase out ranges, it can be, but the biggest determination on what is income is what is passing to you essentially on a K1 if you're in a partnership or an S-Corp or sole prop, just what is net business income, and that's what you get the deduction on.
Okay, so let's talk about that for a second. So when you talk about, these different business entities, let's dive into S-Corp versus the sole prop. How are they treated differently when it comes to QBI?
Yeah, let's say you have a business that's doing let's do 100,000 for simplicity purposes. And after you take all your expenses out, including FICA, Medicare, if you're sole prop, let's say maybe your bottom line is 60,000. Well, that's what you would get your QBI deduction on, is 60,000. Whereas if you were an S-Corp at 100,000, maybe you're paying yourself a wage of 30. That 70,000 then minus, let's call it 20,000 in expenses, you have 50,000 now that's flowing to you as business income. So you'd actually only get a 20% deduction on 50K on the S-Corp versus the sole prop.
That's helpful. So let's see, if the sole prop then is getting the QBI on all their profit, why would you want to maybe file as an S-Corp then?
Oh yeah, FICA, right? Everyone hears it on all the TikToks and Instagram. File as an S-Corp, save on FICA. So you do, on the sole prop, yes, you got that 20% deduction on all 60,000, but you also paid 15.3% FICA tax on all of that, where as the S-Corp, you don't pay that 15.3. So you actually end up still ahead on the S-Corp election in that case, if you were to run the numbers.
Okay, no, that makes sense. And it sounds like there's some flexibility then within the S-Corp as far as hey, how much is wages versus how much is profit, and that kind of can play into those calculations as well, right?
Correct. And you have to pay yourself a reasonable wage. This is where I say, hey, I'm not an accountant. I don't know what a reasonable wage is for your business. Talk to your accountant, get that established. And at that point, if it makes sense to structure as an S-Corp with the wage you're taking, then yeah, because you're not bypassing the FICA tax with whatever's coming to you as a wage in the S-Corp.
Yeah, and that is one of the areas where we do have to kind of take the talk to your CPA cop out, which might be overused, but we do need to use that there as advisors, so I appreciate that. So let's get back to QBI. So entity choice, that's not what creates the QBI, then it just changes how much actually qualifies for it.
Correct. Yep. That's an easy way to put it.
Okay, perfect. You mentioned earlier QBI phase outs. Can you go through the numbers for that? At least for, I know we're coming up on 2026 here, but let's say 2025.
Yeah. Since I have them written down, because I don't memorize any of these numbers, they change every year. But right now, single is 197 to 247, and married filing jointly is 394 to 544. So what that means is if you're below that lower number that I read, it's a 20% deduction on your income, you're good. But once you're above that number, you have to start considering the nuances with QBI because that matters.
You start to phase out a little bit. So what happens then if you kind of go above those ranges?
Yeah, that's where entity choice now really matters, depending on if you're considered a SSTB, which is a specialty service trader business. That lawyer, financial advisor, broker, when they are above that upper number I gave you, they are completely phased out of QBI, no QBI whatsoever. So if you're a non-SSTB and you're above that range, you have a wage test that comes into play where you can still get QBI, but paying yourself a wage now matters, because if you don't, and we'll get into that, then that can impact if you get this deduction.
Perfect. So you already kind of touched on what an SSTB is. Is there anything else you'd add to that? But I feel like we kind of hit that pretty good.
Yeah, I jumped the gun on that one. Sorry about that.
No, you're good. So let's see this. If you're not an SSTB, can you still get the QBI even with really high income?
Yeah, so you're a non-SSTB. You're married, filing jointly, and you're at $400,000 in business income. That would be above the $394 for married filing jointly. Now, we won't go into how you could open up a 401k and contribute pre-tax and bring that under, and now you get 20% total. Obviously, that's an option. But now what they will look at is say, once you're above that threshold, the deduction will be the greater of 50% of W-2 wages or 25% of wages plus 2.5% of property basis. Now, most people just use the wages. So a simple calculation is 50% of wages paid. So in the case of that S-Corp, right, where I use $30,000, 50% of that's $15,000. And if you were trying to take a $400,000 business income at that point and take an 80,000 QBI, well, they're going to look at that and be like, well, no, 15,000 is less than 80. That's what you get.
Okay, that makes sense. Why then do wages, why do they matter so much for the QBI calculation? I mean, is there anything else you'd add to that?
No, that's, again, jumping the gun, but that's basically where it comes in. So when we're in the phase out range, and this is where it gets, again, I'm not even like an expert on this, but let's break this down to like 6 scenarios. Okay. You're either SSTB or you're not. If you're below ranges, that really doesn't matter how any of this works. Now there's being inside the range. And if you're non-SSTB or SSTB, that deduction is phased out. For the SSTB, it's phased out on a scale. For the non-SSTB, they still do the wage calculation to help determine how much of that deduction goes away. But there's a calculation in both of those scenarios that, again, I just go to my accountant and say, what are we looking at, right? When we plan with business owners, it's all about trying to stay under that phase out window completely. And if we get in the phase out window, talking to the accountant and saying, what does this look like? Now, if we're above that phase out, for SSTBs like you and I, financial advisors, we're just out of luck. But for non-SSTBs, now that wage comes in. So that's where wage matters. If you're not paying yourself a wage and you're above those phase out limits, you get no QBI. So that's where that S-Corp structure could really benefit.
Yeah, that makes sense. So too much wage, if you're an S-Corp, can kind of hurt the QBI, and too little fails the test. And so that's where coordination with your professionals really comes into play. I want to go back to something you said earlier. You said that S-Corps can also save on the self-employment tax. Can you dig into that a little bit more?
Yeah, so self-employment tax for all W-2 workers out there, you're only paying half of it. So when we're looking at 15.3, which is the total, you're only on the hook for 7.65. Your employer comes to the table with the other 7.65, and that's split between Social Security and Medicare tax. So for us, lucky enough to own our own business, we pay both sides of that coin. 15.3 adds up real quick. If you have 100,000 in, income for the business as a sole prop, that's 15,300 that goes to the IRS just for FICA taxes. We haven't even calculated federal and state. So with the sole prop, what's nice about that is when you look at your occupation and say, well, someone in my occupation, if I was to just go out and get a job doing what my business does, what I do inside my business, I would only make $40,000 a year. Well, then you can pay yourself that $40,000 as a wage, and you're still on the hook as the employer paying that 7.65, and then the employee pays 7.65. So you're still on the hook for 15.3 on that 40,000. Now the rest comes to you through the business income distribution, and that still taxed it. So state and federal, FICA, substantially reducing your overall FICA liability.
Okay, that's a helpful clarification. And you'd mentioned earlier about to try to double click it, but we can do that now. So you talked about like pre-tax contributions, how that might affect QBI or even like Roth contributions. Can you talk about that a little bit?
Yeah, this is where I went down a rabbit hole. So yeah, let's say you're on the verge of being phased out. Well, for us, if you're on the top line and you get phased out completely and you're SOL, like that's worth trying to find avenues to where you can get back into that range so you can get some QBI deductions. So that's where that 401k that we talked about in a previous video can help out a lot, especially if you're a solo business owner and you can get that all the way up to 70,000 on a pre-tax basis. That comes off the top line, and that's like, that brings down your total taxable income. Now keep in mind, those phase out ranges are not for your business income, they're for your taxable income. So by reducing your taxable income, hopefully that gets you down into that range to where you now qualify for that QBI. And it's still all your money. You're just putting it in a deferred tax account now for you.
Well, so that's pre-tax. What about if someone, is thinking about Roth contributions? How could that play in?
See, and that's where it can bite you, because that's not dropping your taxable income. So it drops your business income because you're putting it into your employee's account, which is you, as a, profit share on a Roth basis, but it's all after taxes. So your taxable income as you shows up as above the phase out range. And so you could run yourself out of QBI if you're too aggressive with Roth contributions.
So there's a balance there. It sounds like trying to balance. We need to get some long-term growth and invest, in the markets, but also, hey, we have this QBI that we want to be aware of, because 20% is 20%. That's phenomenal, right?
Yeah. 401k, and I'll just touch on this real quick. So anytime you make a 401k contribution, it comes from the business, goes to the employee above the line. So then you're looking at the income in a reduced amount. But the benefit of doing that pre-tax still is it still reduces your taxes on your personal tax return. The problem with doing that in Roth is you drop your QBI, you pay the taxes still, but now you get a lower deduction. So you almost would be better putting money into a taxable account because you get the full QBI than a Roth account in that case.
Yeah, no, that's helpful. That's where, the long-term planning helps. And if you're dealing with a family, maybe the spouse is using a Roth through the employer or something like that. So there's different ways we can get money in the Roth bucket if needed. Now, look, if someone's in the 37% bracket, like, do they automatically lose QBI? You're getting up there.
Yeah, and that's why my example too, and using like the max federal rates and you're effective, doesn't even really apply if you're an SSTB, because you're phased out completely once you're into those, that high 37% tax bracket. But if you're a non-SSTB, you can still qualify for the QBIs based off the wage test. And if you're paying yourself a big enough wage, I've seen this where the QBI is actually the lesser and it's still 20% off the total business income.
Okay, so even high earners can benefit if they're structured as an S-Corp and they're paying themselves some kind of wage, right?
Right, and a non-SSTB.
Yes, okay, that's a good caveat. What about state tax? Does QBI reduce state tax as well?
A lot of states recognize the QBI deduction that the federal government gives at the federal level. I don't know how it is there in Seattle, though, because I know your guys' state taxes are a little different.
No, we have no state tax here. We have tax on everything else, though.
Yeah, your estate tax, that's what's crazy.
Yes, the estate tax, the gas tax. Okay, so like if we were to model this, could you just add Utah's rate to the federal rate? Say 4.5 plus 37?
Yeah, that's what I was saying. Yeah, so in the example above, that 41.5% combined is the best way to capture like full savings for those in the highest tax bracket running a non-SSTB business, and that can qualify for 20%. You're saving 41.5% is your taxable income. So every dollar in that QBI deduction, if it's 100,000, 20,000, every dollar is saving 41.5 cents with that deduction.
Yeah, it's hard to find in any other place, right? Biggest takeaway then for business owners when it comes to QBI?
So it's about taxable income. So that matters. Like we talked about, be careful about putting too much into a Roth account if you're close to those phase out ranges, because you may need to do some pre-tax contributions. And then also business type. If you're in those phase out ranges and you have no wages because you're filing as a sole prop, well, now the lesser of 20% QBI and 50% of your wages is 50% of your wages because it's zero. And so, yeah, like if you're not already filing as an S-Corp, that should put a fire under you to do that. Managing wages and contributions to the retirement accounts is how you can help control this deduction and dial it in. And that's why tax planning is so crucial for business owners.
Okay, perfect. And so here we are. Any final takeaways before the year ends, which is crazy. We're talking about that already.
I mean, we're still learning it, walking through it. And this is why we partner with good accountants too, because while we do a lot of tax planning, right, it's not not done till it's filed. And so making sure this is communicated with accountants, it's fact-checked with accountants. I love the relationship we at Rise have built with accountants. I'm sure you have the same relationships out there in Vancouver.
Having that kind of person in your corner is so crucial, especially when you're dealing with more advanced business planning strategies like this.
So excited to keep talking about these subjects. Every flight won't be without turbulence, or some will. But, we created this channel to help our clients and anyone who cares to watch these have the vision to see beyond that next waypoint, that critical financial event that may be on the horizon. So Skylar, thank you for taking the time. Like and subscribe if you want to see more, and we'll see you next time.